We've managed to spike through the middle now, but can we get to the red zone so we can come back to this gold bar from above? That's the idea. This is 227 points from the best price to the end of this trade. And that's why I say when we get into the red zone, it's not a great place to short it, it's a good place to hedge it. At the end of the day, hedging it will allow you to not have to take off as much profit. Yet in the event that your long trade is a bust and it goes down off that level, then you'll be knocked out by your hedge and you'll still have an extreme to manage down 1200 points potentially. But in the event that the hedge is wrong, you still keep this trade going. And this might lose a little bit of money, but damn, if you can drag your stop into profit on that area, then you're set. Emotion's completely eliminated and everything, you know, and I'm also saying, like, in a hypothetical situation, if you have 10 and you use 5, well, for the moment that you're losing on this 5, you're only making half. And you don't have to sell anything. And you know that if this comes down and knocks out your 10, you've still got 5. Taking half of what you have left would be the best idea. The name of the game was to get on top of the red zone so we could smash it from above. And I mean, this gray bar is kind of our red zone. That's the one I was looking at, because it's like we have this range here. This range has been in play for a long time. Look at how we used it overnight, for crying out loud. Very clearly, very concisely, it went back and forth many times, too many times for me to count. And you can see this, like, law is in place where, you know, the middle of that range, how many times we touched that line right there? You know, 100? I don't know. How many times did we make extremes that were valuable? Here, here, and then how many times did we touch the middle again? It's like 100 times versus 7 times, and there's 6 times on either side. I mean, it doesn't have to be a perfect movement like this in every range, right? But we know the law is that if there's 3 times on the top, or say 4 times on the top, and 4 times on the bottom, we've got 1, 2, 3, 4, 5, 6, 7 times we've hit in the middle. You know, literally 4 on the top and 4 on the bottom, 7 in the middle, that's almost double. And this is taking it to the whole next level, where we can have maybe 6 times on the top and 7 times on the bottom, and then 100 times in the middle. Or sometimes we only get 2 on the top and 2 on the bottom. It's like, oh, we get a big spike up here and then a big spike down here, and everyone else just gets all of this time that's not good for them. And I mean, think about from a scale, if I was to take all of this time, say there's 100 minutes there, how much of a percentage is this? How much of a percentage of time is this? You know, are we less than 20% of the overall time that's actually the best price to trade? And the rest of it is actually harmful? It's on the concept of original thinking, but here we are at the red zone, hedge target zone. But here we are at the red zone. And you know, this is the movement altogether that I was talking about. 219 points it's managed to produce. And that gold bar is something of a consideration. You know, any hedge trade can be made absolutely profitable by now. It's absolutely disgusting how much profit they've just given on anyone that decided to hedge from that area. If you let a hedge trade become a loss, like I said, you know, they might allow you to drag your stop into profit from the extreme to where we are. So it's 33 points. So remember how I was talking about smashing the red zone from above, like in relation to this range here? We're on top of it, smashing it from above. Like, this qualifies as a smash, I would say. Very much so. And you know what's funny? Is if this fib set was important, we'd go back to the B point and we'd be done with it. But it's not. It's what, 161? Didn't give it a chance to go to the 188? I wonder why, you know? It's interesting. And we could still go to the 188 and come back to the B point, but there's more in getting back to the gold bar than there is in getting back to the 100. And nothing says that we don't have to chop at the gold bar when we get there as well. It's an area that's like the worst place to trade from, the best place to trade to. Another point to consider taking some off, but leaving more to take off on the bar. If you did take another trade on the top of the red zone, I want to say as well that it's a good time to make sure that it's safe. So what we could do is actually try and respond to the 188-200. You know, because what that could mean is a smaller version of what we did in the morning. Because like if I take off some of these fibs, and we just look at what we did in here, this level up top is a 141, 127. This level up here is also a 188, 200. We had that situation in the morning on the low, but it was different. You want to know how it was different? The 61 was here. Hold on. If I put that there. So this is an interesting one. This right here is talking about going back to that level. This right here is talking about going back to that level. This right here is only talking about going back to this level. So I mean, what that's funny to me about is like, that could be the return back to the tip of the triangle. I mean, this is a sorry attempt at leaving the triangle, I'll tell you that right now, for sure. Definitely not very good volatility. Definitely has a ton of space left. Definitely raises the awareness of the fact that that's the trend line. Like, it is the trend line. Like, look at how when we connect the B point down there, and we connect this high, it gives us this this blue line. And I put these up here for this, particularly, not because I'm bearish. I'm not bearish. I think that there's going to be some decent hedge trades along the way to getting away from this area, and I'm pretty sure, hey morning, I'm pretty sure we'll see the gold bar again at some point here too. Yeah, well, it's still inside of this channel here, and it just managed to get to another area of interest. Like, there's a few things going on here. Like, these 141, 127s lead back to this level usually, which is the tip of the triangle. This 200 and 188 leads back to this level, which is a B point that's untested. We can go ahead and mark that actually now. And then this one down here is a 141, 127 that goes all the way down to this 61, which is the gold bar. So those levels right there, they do present a kind of interesting environment. That's why I mentioned that it was a hedge though, because when we come back up to these highs, like, I can see us getting all the way back into the consolidation above that we left on the original dump. I can see that, you know, the beginning of the day we had major pullbacks, the end of the day we had major pullbacks. I think that what we want to do is ultimately go into this range above and then make a 61% pullback. And I think it would get these people at this B point down here. Like, I think that we want to go up there to respond to maybe a 241 or a 188. Like this, maybe a 261, that could be a nice one up there. But that general area, when we come into contact with these B points up here, it starts to become a risk that we can actually make a 61% retracement on the entire progress all the way up there. And what that would look like is coming up to hit these B points and then coming down to hit these ones. So like that idea of coming up to these ones and then back down to these ones can create this giant triangle. Like, the support line will be able to be drawn in here. The resistance line will be able to be drawn in here. Now, of course, if anybody took these smaller movements, there's more than enough profit to make sure that you're safe by this point. 3:59 in the morning. Here, I posted a good place for profit taking on any hedges or shorts made. See you at the open. There, at the best freaking price.